Today we're going to cover 5 reasons not to use Roth IRA conversions. This video is a follow-up to another video I recorded last week. It was cleverly titled 4 Reasons to Use Roth IRA Conversions. Shockingly enough, it's about reasons you might want to use Roth conversions. Now, while I made the case that Roth conversions are an excellent tax planning tool in that video, they're not for everyone. Here are 5 circumstances where you might be better off not converting your accounts to a Roth. Number 1 is you don't have many tax-deferred assets. Now, this is probably obvious enough, but if you don't have any assets, or very few at least in tax-deferred accounts, then you might not want to bother with conversions. The primary purpose of a Roth conversion is to gain control over when your assets are exposed to income taxes. Now, the balance in your tax-deferred accounts will generate required minimum distributions that are equal to or below your actual expense needs in retirement, then there may not be much of a benefit from converting to a Roth. Number 2 is you don't have cash to pay the tax. Now, since the conversion of assets from a tax-deferred account to a Roth is a taxable event, you need to have some cash available to pay income tax on the conversion. And the more money you have, the more this is true. So let's assume you want to convert $50,000 to a Roth IRA and you're in the 22% tax bracket. The income tax will be $11,000 for this conversion. So that means you'll either need $11,000 available to pay the tax bill, you'll have to cannibalize $11,000 from your conversion, or you'll have to remove an additional $11,000 from your tax-deferred account for the tax. Now, cannibalizing Roth dollars is woefully inefficient because you're basically slapping those funds with a 22% penalty as soon as you pull them out. And the trouble with using more cash from the tax-deferred account to pay the tax is that you'll now need another $2,200 to pay the tax that you were removing to pay the tax. Then another withdrawal of $2,200 is going to trigger a $484 withdrawal in taxes. And this cycle continues until you use cash that you have available somewhere else to pay the tax. So it's better to just have the cash available in the first place, or the math really begins to not make sense. Reason number 3 not to convert is that you will need the money within 5 years. Now, among the most confusing rules in the world of personal finance is the 5-year rule for Roth IRAs. I won't bother diving into a lengthy explanation now. We have another video that I'll link above. But you should know that each conversion you make to a Roth IRA is subject to early withdrawal penalties if you remove the funds, earnings included, from those conversions within 5 years. However, since this requirement is meant to serve as a discouragement to raiding your retirement account early, it does expire once you reach age 59 and a half. So if you have money in your tax-deferred accounts that you want to convert, just know that the 5-year rule will apply unless you're 59 and a half years old. Reason number 4 is you want to keep your income taxes low. And since Roth conversions also increase your adjusted gross income, this means conversions could result in higher Medicare payments thanks to IRMA. In 2025, depending on your actual income, this could result in a monthly Medicare Part B premium of anywhere from $185 to $628.90. That's a range of over $5,300 annually. Now, likewise, the amount of your Social Security payments that are exposed to income taxes could also be increased. For Social Security, if your adjusted gross income exceeds $25,000 for an individual or $32,000 if you're a married couple filing jointly, then some portion of your benefit will be taxed. Number 5 is you plan to give your IRA away. Now, finally, if you're a benevolent person and you plan to use your tax-deferred assets to support charitable ambitions, then you shouldn't pay tax to convert those funds, as they wouldn't be subject to income tax as a donation anyway. Instead, you should look into qualified charitable distributions, or QCDs, which are an effective way of reducing RMDs and avoiding taxes while supporting a charity that you like. In fact, if you have money in a variety of accounts that have different types of tax treatment, odds are making donations from tax-deferred accounts will yield the greatest tax benefits for you. Donations from a Roth are the least beneficial since Roth withdrawals don't increase your adjusted gross income anyway. So Roth conversions are a thing that a lot of people kind of get excited about because they think it's like black belt personal finance, that, there's some kind of a guru or nuance that they do it, but they're not for everyone. Hopefully these 5 reasons will give you some insight into when you shouldn't make Roth conversions. Now, for more about Roth accounts, please check out our Roth playlist. It's linked below. We also have plenty of information on our website at martinmoney.com. As always, I'm grateful for your time and your interest in my videos. God bless and take care.